Hello, everyone, and thank you for joining today's TTI training session. My name is Jay Goodis. I'm the CEO of Tax Templates, Inc. The goal of today is to run you through the changes to the capital gains inclusion rate and how you use TTI solutions for it, and also highlight a few new features. I'm hopefully going to go for about 15 minutes, and then I'll leave any additional time for any questions. If you have questions, you can put them directly into the app. All right, so let's get started. All right, so the first worksheet that I'm going to highlight today is the personal tax scenario worksheet, which is probably the most widely used solution in light of the change of the capital gains inclusion rate. Before I get started, just a few quick reminders. One, there's a big orange box at the very top left-hand side of the worksheet. This will take you to TTI's YouTube video. And also, you'll notice that we have our built-in wizard. And if you just click client description, it is going to take you to the cell to complete. So if I'm doing a file for, say, person A, I just hit enter and you will see the wizard will take me to the next step. Okay, so let's go ahead and build a scenario for our client. I'll use Ontario as our province today, and I'll tell the wizard to move on to the next step. So first off, regarding the capital gains, you will notice there is a line on the personal tax scenario called capital gains proceeds. And whenever you enter in a figure into this particular cell, it is using the capital gains inclusion rate at the end of the calendar year. So for 2024, this will be using the 2/3 inclusion rate. Now, one thing that you will notice when we are doing the calculation, there is a non-taxable portion, but there's also a capital gains reduction, because that's the way the government is doing the math to calculate that 50% inclusion rate on the first $250,000. So a great way to think about it is that every capital gain is calculated at the 2/3 inclusion rate, which is why you see 1/3 being non-taxable, and then they use the capital gains reduction for the first $250,000. Now, if you do have a scenario where your client does have maybe a gain in the first half of the year and a gain in the second half of the year, well, if you click on the capital property link, that will take you down to the disposition of capital property section. And here there is a row titled if 2024 disposed before June 25th. You can mark this as true, and then any capital gains that you put in this section will be before June 25th. If it is at false, it'll be for any capital gains after June 25th. So another popular reason to use this section is when we're claiming things such as qualified small business corporation shares. So to do that, all I'd have to do is change the eligible asset to our qualified shares and drop in the proceeds. So let's go ahead and put in proceeds of, say, $1.25 million. If I jump back up to our taxable income section, you will notice that the capital gains reduction has now increased as a result, because we get that on the first $250,000. And another thing you're going to notice as well is the capital gains deduction is now $833,333. And the reason that's the case is we are taking 2/3 of the new capital gains exemption limit of $1.25 million. Now, another interesting cell that you should be aware of is the capital gains reduction adjustment. And this is a little bit complicated. It's part of 111.2 of the Income Tax Act. And to show you how it works, I'm just going to knock out that $100,000 of regular capital gains we had beforehand. So if you take a look at this example, we have total income of $791,667. Well, look, if that's going to be the case, well, we can't have a capital gains deduction of $833,000 because that exceeds the total income of $791,000. So the purpose of the capital gains reduction adjustment is in order to bring that taxable income back to zero. You will see that for things such as capital loss carry forwards as well. It's a complex calculation, but it is an add back to the taxable income section. Now, when we are running scenarios for our clients, if we want to see elements such as the AMT, you're able to see that on the base results tab, and the AMT calculation is at the bottom. If there are any rows that are hidden that you'd like to see, you can just click the active rows view button on the base results tab, and that will show you all the relevant data for your client scenario. So in this case, we are seeing that 30% add back on that $1.25 million. And there's our new basic exemption at the 4th federal bracket and our new AMT rate at 20.5%. So a new feature that we actually added earlier this year is TTI's Goal Seek feature. And you'll see the Goal Seek feature with the button at the very top of the T1 base tab. And how this works, it helps you solve certain amounts that you need for your client, certain objectives. I'm going to show you how it works with this particular example we've already built. So the first thing I'm going to do is I'm going to choose which engine I'm using. And right now I'm using scenario 1. If I had renamed T1 scenario 1 to anything else, that's the name that would have shown up when I clicked the button for GoalSeek. You will see we have 6 objectives here, but if anyone has ideas for new objectives, please feel free to send us an email at support@taxtemplates.ca. We are looking to add to these based on our client feedback. You'll see here that there's a few objectives, and I'd say the key ones here are individual net cash of X. So that's used for a scenario where a client wants a certain amount of net cash. There's an OAS clawback, which is really great when the clients want as much income as possible before their OAS is clawed back. And we're going to use number 6 for this example, which is AMT carry forward. So let's assume that we need to generate income in order to utilize the full amount of the AMT. I'm just going to leave this as $1. That's just evidence that my algorithm is working. And I'm going to choose what type of income I would want to generate. So let's assume that this client maybe had a holding company and they could receive lots of other than eligible dividends. I just hit 3 for other than eligible dividends. And what the worksheet is going to solve now is how much in other than eligible dividends do I need to generate to utilize the full amount of the AMT. Okay, so it is now fully run, and we can see here it's actually quite a lot in this particular scenario that our client needs $944,219 in order to utilize that full AMT amount. And the type of income that you choose is very important because different types of income are taxed different ways for purposes of the AMT. So income such as interest income or employment income will absorb that AMT much faster than income such as capital gains or eligible dividends. All right, so another thing I want to highlight to you is that in the disposition of capital property section, there is a row titled Canadian Entrepreneurs Incentive Eligible. So if you are looking to see the impact of the CEI, you can just mark that as true. This applies for years 2025 and beyond. So in this case, if I mark it as true, my error guide is going to tell me I can't use it yet because we are still in 2024. All right, so another situation that we will build quickly, and I'm going to use scenario 2 for this, is we're going to build a stock option scenario because I think this is pretty important in light, again, to the change in the capital gains inclusion rate and how stock options are taxed. So what I've done here is I've just clicked my advanced view button at the very top. This unhides more complex elements of the worksheet. So I'm going to change my province to British Columbia. And the stock options are actually in the capital property section or right above the contributions and carry forward section. So let's go ahead and build a really quick example here. Let's assume that our client has 300,000 as our fair market value. We've got an exercise price of $50,000 and they've got 100 securities. So one of the things you'll pick up right away is that the amount for the security option deduction is $83,333, which is 1/3 of the 250,000. Historically, that number would have been at 50%. Although if they were disposed before June 25th, again, you can just mark it as true, and then we will see that calculation. But what's also important is we talked earlier about that capital gains reduction and how that works. So if I'm going to go back to my taxable income section here, and I'm going to hit my minimal view just so there's less rows on the worksheet for me to have to scroll through or to jump around to. But when it comes to the 250,000 capital gain reduction threshold, you can use that towards capital gains, or you can use that towards the stock option deduction. So you actually see there's a row here called capital gains reduction for security options, where we are taking that $41,667 to ensure that we're only getting that 50% inclusion. But what happens in a scenario where maybe we have regular capital gains and stock options in the same year? That's a very common scenario because we might have seen a client, exercise the stock options, then initiate a sale right then after. Well, then you'll need the worksheet will automatically allocate it to the capital gains and not to the stock options. But whether or not that's best for the client is really dependent on a case-by-case basis. So what you're able to do is you're able to hit the optimize button in the worksheet. And when you do, if it is better to allocate them to the security options, the worksheet will do that automatically, or you have the flexibility to do that manually yourselves directly in the discretionary amount section. Oh, well, it's $1 too high there. There we go. And then the worksheet will automatically update based on the input. It'll take the amount out of the capital gains section and move it into the capital gains reduction for the security options. So just be mindful of that important feature. I think when the tax return software is released, we're going to see some sort of election in the software in order to do that, but you can't optimize it right now in TTI solutions. So another key feature to bring to your attention is our contributions and carry forward section. And I'm going to just reset my amount that I put for my capital gains reduction threshold to show you how something might work. You will see we now have two different input sections for our net capital loss at the half inclusion rate and the net capital loss at the 2/3 inclusion rate. So the reason why this is important is when you put in a capital loss carry forward at 50%, so let's assume $10,000, and then we claim that $10,000, you're going to notice in the worksheet, it's actually being grossed up. And what we are doing is we're multiplying it by 4/3 in order to match the new 2/3 inclusion rate at the end of the year. But another thing you are going to notice is that there's that capital gains reduction adjustment, again, automatically calculating. So if you were to net these two, it's going to calculate at that $10,000. And the reason it's calculated $10,000 is that we have our capital gains here being calculated at the 50% rate. But if we had a whole lot more in capital gains into the worksheet, you will notice that the capital gains reduction adjustment is no longer calculating because we have enough capital gains to absorb that increase to 4/3 on that $10,000 capital loss. It's all being done by the worksheet. It's a lot of mathematical gymnastics, but it is all here for us. All right, another key feature to show you is that we created this experimental feature, which our clients have been using, and so far the feedback has been great. So if you have any feedback about this feature, please let me know. But one of the challenges is when the rules changed specifically for AMT, clients were looking to run calculations for inter vivos trusts. So you'll see there's a new row if you hit advanced called simulate an inter vivos trust, and it is experimental, so please use discretion in this scenario. So I'm going to just create the province of Alberta, and I can just mark this as true. And when you mark it as true, what it's going to do, it's going to take away your basic personal amount. It's going to have all income being taxed at the top rate. And then we've also removed the AMT threshold on the fourth federal bracket and brought that down to 0. So what that means is you can then build your trust scenarios here and also look at the scenarios if you were to allocate those funds to different beneficiaries. So, a very simple example might be is, let's say our client had some capital gains of $100,000. Well, if we want to allocate that $100,000 beneficiaries, what we would do in the worksheet, let's say we want to allocate it, 90,000, I can just go ahead and minus 90,000. Maybe I'll use the note cell to say allocate 90K to beneficiaries. And then I could use my other scenarios to put in that $90,000, such as to, my beneficiary number 1 over here, who may be in Manitoba. Another reason this is important is if we had elements such as a carrying charge, we know that we could still have situations where AMT will apply. So I can just go ahead here and just put in, say, $10,000 in carrying charges. And in this example, where you've got $10,000 in capital gains and $10,000 in carrying charges, or even maybe, a little bit less, just to make our taxable income 0, you can then see the impacts AMT on the base results tab, if there is any, for scenario 3. And we can see here, because of the changes to the AMT as they impact trust by having that exemption down to 0, AMT is still going to apply for this particular scenario. It's a real helpful way in order to build those inter vivos trust scenarios and also show the beneficiary allocations directly on the worksheet. Now, another experimental feature we have is our Canadian residents. You're able to build a scenario here where you can mark them as a non-resident and it will do the calculations for you. Again, please use caution and review the numbers carefully. It is experimental as we look to make any updated changes to the calculations, but in light of some of the demands by our clients who need this right away, we released it a little bit earlier than intended. All right, and I think one more thing to bring to your attention is that in the tax credits and other amounts section, we do have the support for both the 15% and the 30% flow through calculations. And in the August legislation, we also saw changes to the AMT calculation when it comes to flow throughs, where it is no longer added back for the adjusted taxable income calculation. So that has been introduced into the worksheet as well. All right, so hopefully that takes you through some of the more critical impacts of the changes to the personal tax scenario worksheet. I'm going to take you a few through the corporate tax scenario worksheet next, and then I will open up to any questions from the audience. Okay, so in the corporate tax scenario worksheet, this is built for our clients who are just corporations, and we want to run our different scenarios. I will remind everyone, and this is true in the personal tax scenario as well as the corporate tax scenario, is that whenever you make the client's name the same, it is going to copy over all of the information from scenario to scenario. So like, it's really helpful if you want to build scenarios, everything copies across and you can just go ahead and just change the unique numbers that you're looking to change. All right, so in this case, let's build a scenario with December 31st, 2023 in scenario one, and we'll do December 31st, 2024 in scenario two. And I think we'll just do this just to show the different impacts to the capital gains inclusion rate from one year to another. So in scenario one, you can see our 50% inclusion rate, 50% of $100,000. And in scenario two, we can see there is our 2/3 inclusion rate with only 1/3 being non-taxable. When it comes to our corporations, there is no 250,000 threshold. So every dollar is being taxed at that new inclusion rate. When you do enter in these numbers, if you go look at the corporate taxes and cash section, which I'll get to by using the link at the top, you can see the changes in taxes from 2023 to 2024. I think something important to note here, we do have increases in all the corporate taxes, the Part 1 non-refundable, the Part 1 refundable, and also our provincial taxes, because the provinces are following the federal's lead. The only provinces that could change it is Alberta and Quebec, and we haven't heard anything from them that they aren't going to follow the federal government's lead in the change to the capital gains inclusion rate. You'll also notice that in the contributions and carry forward section that we have our note cells, and this shows you how much in dividends in order to pay in order to recover all of the RD2H. So those are certainly higher now because we have higher RD2H balances because of the increase to the inclusion rate. You'll also notice in the CDA section that in the CDA section here, we only have 1/3 being added to the CDA in 2024 versus half in 2023. So please keep that in mind for any planning that your clients may have. Similar to the personal tax scenario in the in the disposition donation of capital property section, you can go ahead and identify any capital gains before June 25th. And what we will do is calculate that mixed inclusion rate. For those calculations that to be weighted average together before June 25th and after June 25th. And the last thing I'm going to mention is that in the CDA section, you will see a new row titled here saying capital loss claimed adjustment. This is as a result of, again, the August legislation. The government has come out with a mechanism to try to ensure that the amount of your carry forwards or carrybacks or capital loss carry forwards or carrybacks give you the same impact for CDA as you would for a capital loss. So the idea being here is that when you are carrying forward a capital loss, it's going to adjust the CDA balance as if that capital loss happened in the same year as the capital gain. So it really takes away any of the advantages when it comes to CDA planning in years where there's a change to the inclusion rate, but also takes away the detriment as well for those who maybe were not able to plan around it. So just be mindful in those situations where you have a capital loss carry forward that there's a new row here, and you will see a note pop up as well, informing you that you may have a balance to include there and how much. All right, so hopefully that brings you through the key changes. Again, a few minutes over, I said 15 minutes, we're at 18 minutes. I'm going to open up to questions now about the worksheets. Okay, first question I have here is when will the 2025 rates will be available? Well, we are going to know what the final indexation is going to be from Stats Canada in the next couple of weeks. So we are aiming to have it out by the end of October or first week of November. Can I share the PDF tax tables with my clients? Yes. So in your tax planning support folder, here are the tax tables. You are able to put them on your website, share them with your clients. If you've already provided us with your logo, then your logo is there for you. And again, advertising and branding for your firm. My firm logo is not yet on TTI Solutions. How do I do that? If your firm logo is not on TTI Solutions, just send a copy of your logo to support@taxtemplates.ca, and my colleagues will put the logo on for you and let you know when your new TTI suite and tax tables are online. Where do I access the ITC inputs for flow-through shares? So that's in the personal tax scenario worksheet. So in the tax credits and other amount sections, that's where you're going to be able to find those ITC inputs for the 15% and the 30%. When you do open the worksheet, it is opening under what we call the minimal view. So in order to see other elements such as the capital gains exemption planning, donation of stock options, flow-through elements, you hit the advanced view button, and then you'll go ahead and click the tax credits and other amounts. It's important to ensure that if you want to see provincial related amounts, to include the province before you hit the advanced view, because it's only going to show you the rows for the provinces you've entered into the worksheet. Will the worksheet optimize how much of the 250,000 capital gains deduction threshold will go towards stock options or capital gains? Yes. So the reason why this is important is because you could have capital loss carry forwards, or when you claim the stock option capital gains reduction adjustment, that's happening in the taxable income section of the worksheet. So because it's happening in taxable income, whereas the amount for capital gains is happening in total income, that could potentially have an impact on your net income, which can affect transfer payments or other calculations as well. That's why it's important to look at the optimization. But yes, you just click the optimization discretionary amounts at the very top and it will do the calculation for you. I'm trying to optimize dividends from a opco between husband and wife. Which solution should I use? So in that particular situation, you are going to want to use the salary versus dividend 8 worksheet, 2 to 8 worksheet. So in the solution, you can go to the Remoon 8 tab, and on the Remoon 8 tab, you will see a button that allow you to optimize the dividends. That's right here, optimize amounts between 2 taxpayers. And if you click that link, you can choose the taxpayers, you can choose type of income such as dividend, and decide which one of these optimizations you want, a specific amount, extract all cash, and the worksheet will automatically determine how much in dividends to give to each of the spouses in that case. On the T1 base tab here, this is where you can include the base income of spouse A and spouse B. So spouse A was at 150,000 of income and spouse B had $25,000 of income. When the optimization will run, it will allocate more income to spouse B because they are at a lower tax bracket. My client has a significant shareholder debit balance that needs to be cleared. I need to determine how best to clear the balance to cover personal taxes owed to CRA and clear the balance. Can you walk through how to do this? Okay, so this is done in the salary versus dividend worksheet. And I actually have an example here for an Ontario client. So we'll open up the solution here. So in this solution, there's lots of different objectives we can solve for in this particular solution. To know what those objectives are, there is a PDF in your support folder. And in the PDF, here's all your salary dividend objectives. And on this PDF, you can read about each objective and when to use it. So this is very helpful. But if you have any questions about which objective to use, feel free to email us. Happy to help you. So in this case, we want to use individual net cash increase. And as you can see, it's one of the first ones on the PDF here. Taxpayers as shareholder debt balance they are looking to clear. So in this scenario, how we would build it is step number 1 is we go to the T2 tab, and this is where the workbook normally opens. And what you want to do is tell the worksheet what's happening to the corporation before the remuneration plan. So here in scenario 1, this is an Ontario corporation for 2024, and I've dropped in some active business income and some investment income. Okay. I will highlight that when you are using the salary versus dividend worksheets, be mindful there's a payroll tax section because in provinces such as Ontario, BC, and others, there's employer health tax, and that could impact whether salary or dividends is more optimal. So just include the remuneration paid in this particular cell if it's applicable. Once you've told the worksheet what's happening to the corporation, you can then move on to the individual. And this is where you include the base income of the individual, because we will calculate everything at the precise marginal rates. So in this case, we got 100,000 base income. We're going to calculate every dollar above $100,000. Your final step is to go to the Remoon 1 tab. And this is where you can choose how much you want to optimize. So in this case, if they have a shareholder debit balance of $150,000, we're going to determine how to get $150,000 inside the client's genes. So scenario 1 is using salary. You can see the drop down of the different types of income. Scenario 2, dividends. Scenario 3, salary and dividends. So once you fill in the section here at the top, you can hit the optimize all scenario button here. And I've already run this, so I'm not going to click the optimize button again, but then the worksheet will automatically calculate for you what the differences are. I really like using the charts in this particular scenario. So if you go to the Remoon 1 cash chart, it's going to show you how much corporate cash you need to use in order to target that 150,000. So you can see here that in all 3 scenarios, there's 150,000 of individual net cash, and underneath there's corporate net cash. And you'll notice in the 3rd scenario, we're using less corporate cash than the other 2 to arrive at the same target of 150,000. So The algorithm figured out some allocation that beat out dividends only by 4,200 and beat out salary only by 14,000. To figure out what that is, just go to the very next tab where it shows you the corporation before and after, and you'll see the worksheet is going to show you how much of the different types of income. So in scenario one, it's salary of 297,000. In scenario two, we have eligible and other ineligible dividends. Both of those have been optimized. And the optimization determined, well, the best course of action is other ineligible dividends of 40,000 and then transition to pay the rest by salary. And if you go to the next tab, which is your net taxes and cash, it's going to show you where all your cash is at the end of the day. So you got your 150 to clear the shareholder debit. You've got 261,000 of corporate cash left over. And this is the amount of additional tax we pay to the CRA for personal taxes. And we also know our total corporate taxes as well. So effectively, the algorithm not only determined how do we get the 150,000 in the client's genes, but it's also figuring out how to do it in the most tax optimal way. Okay, so I ran through that salary dividend one very quickly, but if there's any follow-up questions regarding that, please let me know. All right, and I've got one last question here. My client is deciding between selling assets and shares. How do I do this efficiently? Okay, so it's actually the exact same worksheet we're in, the salary versus dividend solution. So I'm going to just open that up one more time. The only difference is we are going to use the corporate transaction tab in this particular worksheet. So same idea. First thing you want to do is, tell the worksheet all the information about the corporation, just in case there's any, opening balances that might be critical or additional cash flow. You also want to go to the T1 base tab, tell the worksheet anything the client has already earned so we can calculate everything at the client's precise marginal rates. So if I put in $500,000 of income, everything will be calculated at the top rate, for instance. And to do this, you just go to the corporate transaction tab, and the top of this worksheet is for assets. The bottom is for shares. You can also click the links here to navigate it a little bit faster. But if we had a very simple scenario where the client was going to sell maybe, goodwill, and they could sell goodwill for, $3 million if they sold the asset of goodwill. The alternative is they could sell shares. So I'll go down to shares here, and I'm going to say that we could sell those shares for maybe $2.5 million. I just have to identify the type of asset. Is it qualified small business corporation shares? Because if it is, we're going to do the capital gains exemption and so on. And you can also see there's a new row here for the CEI. So if you're doing something in 2025 or beyond, you will be able to mark that as true or false. Once you do that, you can go to the Remoon 1 tab. This is where we'll do our optimization. So I'm going to just hit optimize scenario 2. It's the only one that needs to be optimized, and choose between 1, 2, 3, 4, or 5, which is how quickly effectively you want the algorithm to run. If you choose high level, which is 1, it's going to run faster, but it's going to give you a bit more of a generic result. If you want it down to the dollar, then you're going to click 5, and it's going to get you a very detailed answer. It just might take an extra minute or so to run. And what's happening now is the algorithm is running, and we are going to be able to compare disposing of the shares personally and claiming that capital gains exemption at that taxpayer's precise marginal rates, which in this case is the top bracket. And scenario 2 is going to look at selling the assets in the corporation, and then we're going to extract all the cash using dividends and capital dividends. So again, it's going to optimize the amount of capital dividends, and then we have a true apples to apples approach about what scenario is going to be optimal for the client. All right, so now that it's running, once it is done, it is going to hide all those additional rows. So again, a very efficient review, and then we can see the results in just a moment. All right, just see if there are any other questions while this loads. If I run a CEI example for the year 2029, is it going out that far? Yes, all worksheets go until 2031. So yep, all those CEI calculations far into the future are there. So if you are looking at a client who might sell their business in 5 years, you can see what the impact will be. Okay. All right, I'm going to circle back to this example now. Okay, so this scenario is now done here, and you can actually see in the integrated net cash, or you can focus on the marginal net cash. It shows you the total cash under both the strategies. So if we were to sell the shares for 2.5 million and claim the capital gains exemption, the client's going to be left with 2.41 million. And if they were to sell the assets and then distribute them by CDA and other eligible dividends, they'd be left with 2.28 million. So in this case, we can see that selling the shares, even at a $500,000 less of a purchase price, still leaves the client with more overall integrated net cash, assuming everything was paid out in the same year. All right, so we're right on the half hour, and I think I've gotten to all the questions. So thank you for everyone who submitted questions and joining today. If there are